Since we're running out of time, so can you? I request everybody to make their the questions short and sweet. Yeah.
My name is the Islamic banking deposit fully 100% guaranteed by the Malaysian PIDM as the conventional banking deposits.
It is. So it is sort of, instead of guaranteed by insurance, is covered by the kafir. But the reality is, when in a system where 80% of the funding is guaranteed by the government, then 20% also want the same treatment, right? Because what happens if you don't give the guarantee, or rather the takaful cover for Islamic, the cost of managing the funds goes up. So if I tell the Islamic investors, sorry, there's no takaful cover, there's no government guarantee, I can't give them the 3% that conventional banks are paying to their depositors. Am I right? So that means I have to give them based on the underlying risk that I'm taking. So they may say, look, since there's no guarantee, pay me 8%. That's the risk that I'm taking. So the moment Islamic banks have to pay 8%, then they cannot give a 20-year home financing at BFR -2. So the conventional system, which is supported by the regulators and the guarantee and the insurance system, effectively deflates the price, which makes Islamic banking uncompetitive in the market. Therefore, they have to also seek the takaful and the guarantee to lower their cost of funds. So the answer is yes, there is a takaful cover.
Can I just add on that part? Some people misunderstand that Islamic bank, we've been emphasizing on the Islamic part of it, but it's also a bank. So whatever attributes of a bank, compliance, governance, risk management, is all embedded within the bank itself. So the Islamic bank is no different from commercial bank in terms of the governance, in terms of the compliance requirement. So all internal processes we are the same. Islamic bank or commercial.
Right. Next question.
Assalamualaikum. I have a very straightforward question. Do we have a structured and well-developed global regulatory body to govern the Islamic finance? Especially when one of the speakers said the Islamic finance products will start to innovate and will grow bigger market in the next future. Do we have a centralized body to govern this, to make sure it sticks the principle of Islamic finance?
Next question, Rafe.
Hi. I just would like to seek your views on Islamic derivatives, things like the salam and arbun contracts, and how they run parallel with the conventional derivatives, futures and forwards. So just your pick, please.
Okay, I'll answer the first question. In terms of a centralized world governing body, if you think about it, on the conventional side, there is no centralized governing world body that governs conventional banking, etc. That's one of the reasons why there's conventional bankers went into trouble in 2008, 2009. And just to touch also in terms of the harmonization, it is true that about 80-90% is in agreement. But again, it goes back. At every conference we always have this discussion, but then it goes back also on the conventional side. You don't ask the English law to be harmonized with the French law, to be harmonized with the American law. So why do we have this discussion on the Islamic side? But then, having said that, I mean, we do have like the IOF that tends to have some understanding of what's going on the Islamic side worldwide. So that can be a reference point. But it's good to have a reference point rather than having a body that says you have to do this, because that will restrict innovation. To touch on the derivative side, there are things that in Islamic finance that actually mirrors derivatives. It's something that we have done throughout the whole our life, our time. For example, when you put a deposit for a car, you put a deposit, say 10%, and then you say, okay, I'll pick up the car in 3 months' time, and I'll pay the whole value. But in 3 months' time, when you decide, okay, I don't want to pick up the car, so I sacrifice the 10% deposit. Now that is an arbun contract, and that mirrors an option. So although you call it as derivatives, conventional derivatives, you have an Islamic derivative that mirrors the conventional, but the underlying principle behind it, although it appears similar, it's actually quite different. And one thing about Islamic derivatives also, you have to have an underlying. When it comes to the time of settlement, you have to actually physically own the asset to settle. So that also, in a sense, will restrict the amount of Islamic derivatives in the market. And that was one of the other problems with the crisis that we faced. But there were derivatives being written on derivatives and on derivatives. And there's so many derivatives in the market that the underlying asset was, about 100, 200, 1,000, a million times over than what the actual asset was.
I think if you look at the origin of Islamic derivatives, for many years, Islamic finance have avoided derivatives because derivatives were structured based on commodity trades which are not really linked to the underlying. So, for example, Islamic banks used to give 20-year home financing, which is fixed rate. Now, the rates are fixed for 20 years, and then on the liability side, when Islamic banks take deposit from the customers, the deposits can go up depending on where the market rate is. So, naturally, when Islamic banks adopted the conventional financial model, they have no option but to also adopt the conventional derivative tools. So they need a profit rate hedge in order to make sure that their fixed rate asset is matched with their floating rate liability. So although the concept of Islamic derivative doesn't exist in its classical form, it has been introduced in the current market because Islamic banks have been forced to adopt the conventional model of having a floating rate liability with a fixed rate asset and not adopting the original model of sharing the risk and reward. And given that the sharing of risk and reward is a long way to come, by the time Islamic banks get the dominant market share and shift the way banking is done, until then they need to be sustainable. So they have now gone into Islamic derivatives using various commodity-linked transactions in order to hedge their mismatch.
Any more questions? I hope this is a sign of, okay, one more. At the very end.
I just want to ask, does the pure ideal Islamic banking model means, when you say complete risk and return sharing, does it mean basically mean equity investment, no more bank loans, right? That's the first question. Second question is, how do you, when you give money to someone, how do you ensure your interest is being protected first before the owner's interest? As in, when bank loan, it comes to bank loan, you are given the first security. In exchange for that, you get lower return, right? But equity, you don't have that. How do you ensure the interest of the lender is protected?
So when you look at the ideal model, it doesn't mean there is no such thing as fixed income or debt concept in Islamic banking. So if I am an Islamic finance house, I have say 20 portfolios that I manage, and you come in and say, look, I'm going to moderate risk. So I can tell you that, okay, I'm going to take your investment, and with your investment, I get other investors to pool in, and under that pool, I can buy, cars to lease. So when I buy cars and then I lease, it becomes a leasing fund. So when you lease out to the customer's rental becomes a fixed income component for me. And given that I own the assets, I effectively own the asset. So I don't need to even take a charge. A charge is, the customer owns the asset, you have the first security interest. You have to still go and foreclose on the asset. But if you own the asset under the leasing fund, you can just walk in and take the asset. You don't need to go for a foreclosure. So the concept of security is well understood and acceptable from the Islamic viewpoint. Plus, the nature of the returns can also be fixed income. So you can have the profile of a conventional loan, but the key distinction is if the portfolio tanks, right? The investors cannot run to the bank and say, give me a principal back, right? You take the risk of stay on the line. So technically, they cannot be run on the bank. Because like a mutual fund, you can have 100 mutual funds, 10 can go down, 90 can be sustainable. So effectively, the banking system is sustainable because you can, if all of them come on the returns, then the fund will be liquidated and you get your NAV.